discussing the capital gains tax, but I think it is an interesting issue and an important issue, and I know that this is a debate topic for all of you, so hopefully this will be enjoyable. I'm going to say at the outset, I have done 4 presentations today. I don't want to just talk. I want to hear from you, and I understand that the questions are by text, that you're going to be sending messages, but I hope that you will do that throughout this so that we can make it something closer to a conversation and not merely a lecture. I have not planned this as such. I would like to have this be as interactive as possible. But I do want to cover a number of things throughout this conversation tonight. I want to talk about why capital gains taxes exist, what the rationale for them was, where they came from, how they've changed over the years, what the economic implications are, what the implications for work and for investment are. Just walk through a number of the different provisions of capital gains taxation and try to give all of you a sense of how we got where we are, how to think about capital gains taxes. I'm not here to answer your question. Your question or your debate point resolved the United States should abolish the capital gains tax. This is, of course, something that people have debated for a very long time, really since the creation of the capital gains tax, which goes back quite a long way. In fact, capital gains were taxed in 1913 when the individual income tax was created. They have always been subject to that tax in varying ways over the years. But I hope to help inform your thinking on this and, again, to answer any questions you might have to prepare you as best as possible. So let's talk a little at the start, or at least pose the question and maybe let you think about it. Why do we tax capital gains income, or maybe more broadly, why do we tax income? Because, there are a lot of different things that we can tax, and as all of you, I'm sure, know, until 1913, the United States generally did not tax individual income. Sure, there was a brief experiment with this during the Civil War. There were a few other experiments here and there. The Supreme Court didn't think much of those until the 16th Amendment was ratified. But why do we tax it? And should we be taxing it? We often hear these debates about should we have income-based taxes, should we have consumption-based taxes? And much of the rest of the world is more consumption-oriented than we are, which isn't to say they don't have income taxes. But you look at, say, a lot of the OECD countries, and they'll be focused much more significantly on a VAT, a value-added tax, which is, of course, a form of consumption tax. Now, what is the fundamental difference between an income and a consumption tax? That might seem like a silly question. Obviously, one is on your income, one is on your sales. But there's perhaps a better way of looking at that. What is income? Income is an aggregate measure. Income is both the amount of our current consumption and our savings and investments. Consumption is, of course, a portion. It is a subset of the income tax, or of income generally, rather. And that's important because, simple truism, whatever you tax, you get less of. So if we tax all income, and we tax that investment portion and the savings portion rather than just the consumption portion, we are in some ways skewing the economic behavior of individuals. And you're going to do it regardless. You're going to do it if you just tax consumption. But when you think of the possibilities of what you can tax investment, you can tax consumption, you can tax property and ownership. And some of these things are going to be more likely to change than others. If you're taxing investment or business activity, you may get less of that. If you tax consumption, we may care less economically about getting less of that, which is why traditionally we've often seen many, especially on the right, favor a more consumption-oriented form of taxation. This is also a reason why capital gains taxes have been particularly notable because, of course, this is very explicitly a tax that deals with investment. We all understand that the capital gains tax is obviously on the returns on investment, that it is the net of that you can have gains and losses, and they do offset. We'll get into more of the details of that later, but this is absolutely your return on investment. And here's another aspect of this before we go take a step back and look at further detail. We often talk about making sure that you tax every activity or every transaction only once, whether that's a sales tax, whether it's any other form of tax. You might want to tax all of the activity, but you certainly don't want to double or triple tax it. So let's think about what a capital gains tax looks like in context of the overall tax pipeline. First of all, of course, there's a business that is earning this income. Some corporation out there is engaging in economic activity, and it's subject to the corporate income tax. So that's one level of tax. Of course, Individuals are then purchasing equity stakes, shares, stocks in that company. Their income from which they purchased that has been subject to the individual income tax. Now, once they obtain gains from their investment, that is subject to the capital gains tax. This is double taxation. In some ways, you could even argue it's triple taxation. And then, of course, you have a dividends tax as well. So if you went that route, you're also being taxed there. And this, incidentally, is why, if you've ever wondered why are there different rates on corporate income and pass-through income, because pass-through businesses, think your S corporations, your LLCs, your partnerships, go down the line. These are taxed through the individual income tax. And this became a source of controversy in the recent tax reform debate. Well, if we cut the corporate rate to 21% and small businesses could still be paying up to 37%, aren't they getting a raw deal? And the answer is that corporate income is always taxed twice. It's taxed first at the corporate or the entity level, and then secondly at the ownership level, and then potentially 3 times, because you do have all of these different layers of taxation. And that's why the capital gains tax is perhaps so unique and so harmful. I'm going to go backwards, but first I do want to take a question that I have already asking that wouldn't a tax on consumption slow down economic growth since people would be consuming less and businesses selling less? And this is a very good question. And obviously, like I said, any tax on any activity is going to have some impact on that activity. So a tax on consumption will have a marginal effect on consumption. Of course, another thing that drives consumption is, of course, our after-tax income, our essentially capacity to make purchases. So this tax is already going to create greater after-tax income. You could argue at very least this is balancing out. But more importantly, there's the question of, does consumption drive economic growth? Does investment drive economic growth? These are the supply side versus demand side debates that have been going on for a very long time. And perhaps somewhat curiously, the Keynesian notions have generally been based on consumption, which is why the prime the pump concept exists, that during an economic downturn, the government should be spending more, they should be deficit spending to prime that pump, to put more money into the economy, into the hands of people who are consuming. Interestingly, supply-side conservatism actually borrows many of the same ideas, the idea being that if you put more money into the hands of consumers, of individuals, that they are going to buy more, and that this demand side more than the supply side is going to be what drives it. And I think I misspoke earlier that many of the policies of the right in recent years have been demand side more than supply side, even though you often hear the term supply side economics. Generally speaking, a tax on consumption is going to be far more neutral because it waits until the final transaction takes place rather than taxing at the point where the money could still be reinvested. Because the highest return on investment, or rather the highest economic growth, is always going to be associated with investment, not consumption. Of course, we earn to consume. If we couldn't consume, we would not earn. Nonetheless, clearly consumption does not grow the economy in the way that investment grows the economy. It is the teleological reason for investment rather than its source. So let's look a little at capital gains taxation more generally, and please feel free to continue asking questions. Firstly, it's worth noting the United States is unique in the way it imposes capital gains taxes. We're among the highest. In fact, we have the 6th highest combined capital gains tax rate in the world, at least of the developed nations. It's 28.6% on average, the combined state, federal, and local, in some cases, rate. That is 10 percentage points higher than the simple average in the developed world, and it's 5 percentage points higher than the weighted average. So we are a bit anomalous here. 9 industrialized countries actually don't even have a capital gains tax. And there was a time when that seemed very plausible. Just recently I found myself reading Bill Buckley's book, God and Man at Yale, which somehow I had never read before because while perhaps I had an interest in God and man, I didn't have that interest in Yale. But I took a look at it, and one thing that he complains about, well, what a collectivist society we are, that we're taxing capital gains, and that his professors were in favor of it. And honestly, these days, probably some of your most free market professors would just accept this as a given, that of course you tax capital gains as a form of income. Maybe you want to make some adjustments because of the double taxation or some other reasons we'll get into. But certainly the window has shifted here. When William Buckley wrote his book, this was still a heavily debated topic. This resolution that you were debating was still something where he thought the majority might have been with him. I'm not sure it is anymore. So you have an uphill battle, but there is this sense that you're taxing something that has already been taxed multiple times. Capital gains taxes represent a bias against saving because consumption doesn't have as many levels of taxation, and what's ultimately consumed, of course, any income, the consumption taxes are being applied. So if you tax capital gains, if you tax income, and you tax consumption, again, multiple taxes on the savings itself, and that bias is a concern because less savings means less capital available in the future, less economic growth. Under the federal code, one of the issues here is that an increase in an asset's price is determined as a nominal amount, not adjusted for inflation. And this is one of the big concerns with capital gains taxes generally. You know, you buy a stock and it appreciates in value. You see a 20% return on investment over 5 years. Well, okay, great. But on the other hand, over those 5 years, perhaps inflation wiped out 5 or 6%. In real terms, you earned maybe 15% return. But in nominal terms, you earned a 20% return. When you're taxed, the IRS doesn't care about real terms. They care about nominal terms. So if you hold an investment long enough, you are potentially losing significant value. And sometimes this is very real. In some instances, the practice of taxing nominal gain has led to an infinite rate on real capital gains because all of the gains are due to inflation. For instance, if a taxpayer purchased a stock in 1999 or 2000, or even in 2007, again, right before the recession, and then they sold that in 2013, they would be taxed entirely on inflation if they purchased the average stock or if they purchased an index fund. All of the gains they would have experienced, which would have been substantial, would in fact have been inflation. These are nominal gains on the order of 19%, 12%, 8%, real gains of 0, but they'd be taxed on those rates. So these high taxes on capital gains are distortionate. They're causing lower overall investment and higher consumption. Obviously, outright repeal, as you're considering, would be a pro-growth change. It would decrease the cost of capital and increase the amount of capital available. That, of course, has productivity effects. It raises average wages. It's also costly for the government, which is probably one reason why you're not likely to see it. If impractical, a second option, of course, is inflation adjustment. That at least addresses the first issue here of whether you're taxing an actual gain or whether you're only taxing a phantom gain that's wiped out by inflation. And you'll often hear the argument that the reason we have these lower rates, these preferential rates for capital gains, is to address the inflationary issue. But I would point out that it's only a partial way of addressing them. Because, again, going through those examples, 1999, 2000, 2007, buy any of those times, buy an index fund, sell in 2013, you have gains on paper. You have no actual gains. So it doesn't matter how discounted the rate may be. You're being taxed on income you did not actually earn. Now, of course, just structurally, just a quick point, of course, capital gains are taxed at differential rates based on which income bracket you fall into. We'll go into those rates shortly. But capital gains do receive this preferential rate. Capital losses offset those. But if your losses exceed your gains, you can only actually write off $3,000 beyond your gains in a given year. Anything beyond that, you have to carry forward to future years. This means that capital gains are subject to an immediate tax liability, but capital losses don't yield an immediate tax benefit. That's certainly a non-neutral treatment. We are giving more preference on one side of the ledger than the other. Let's talk a little about the history, because that was something that I was asked to explain where these came from. Well, the reality is that when in 1913 we first adopted an individual income tax, pretty much everything was taxed. It was a top marginal rate of 7%, so a lot lower than we have now, but all income was taxed as if it was ordinary income. In 1921, that changed a bit. The Revenue Bill of 1921 created a new top rate of 12.5% on assets held at least 2 years. And that was really important because a lot had happened between 1913 and 1921. There was, of course, a Great War, and with a Great War came a great tax increase. Now, technically, the tax rate rose from 7 to 8%, the top marginal rate. No big deal, right? 7%, 8%, not really that big of a deal. One thing important to mention, the 65% tax surcharge rate. So the actual rate was 73% in 1971. So when we first see a bifurcation of income, ordinary income and capital gains income, this 12.5% rate is combined with bringing down that top marginal rate to 58%. Still sounds extraordinarily high to us today because, of course, we had seen 39.6 in recent years. It'll now go down to 37. It has gone down for this year to 37. At that point, it was being brought down, big tax cut to 58%, and capital gains at 12.5%, but you had to hold it for at least 2 years. There was no preferential rate whatsoever if you didn't do that. Then for a while, we started looking at different ways to address that question of inflation. So there was a period for which you could take a deduction for 20% of the value if you had held the asset for at least 1 year, 40% for 2 years, 60% for 5 years, 70% for 10. Very crude way of handling inflation, but nonetheless trying to address that. Then in 42, you could exclude 50% of assets held at least 6 months, or you can elect an alternative 25% rate, either or, not both. The long-term capital gains rate phased to 35% under the Tax Reform Act of 1969, thanks President Nixon. He also created the AMT under that bill. It wasn't a great year for taxpayers. And there was a 10% minimum tax on excluded gains. Under Ford, it increases further, and the holding period changes. So now it's 1 year. This is what we now think of. Long-term capital gains are 1 year, and that is something that emerged under President Ford in 76. Then you get to a couple years later, 78. The excluded gains concept disappears. The exclusion is increased to 60%. And that yields an effective 28% rate, even though it has a much higher nominal rate. In 81 under Reagan, it goes to 20%. In 86, we start to get the modern form. The 1986 Tax Reform Act repeals the exclusion. You no longer get to deduct or exclude a certain amount based on how long you've held it, but we change the rates. Now it's 28%. And that was actually in line with the new ordinary rates. But then, of course, they diverge. Under Bush, read my lips, no new taxes, and then new taxes. We saw a minor increase. We saw further increases under Clinton. And then you see that divergence where capital gains are again taxed at a lower rate. They stay at 28%. The individual code goes higher. Clinton then made some further changes for lower rates for longer held assets. And then we get the Bush tax cuts of 2001 and 2003. 2001, EGTRA doesn't really matter much here. 2003, JEGTRA brings the long-term rate to 15%, 5% for low-income individuals, those that fall entirely within the bottom two brackets. And then under the American Taxpayer Relief Act under President Obama, which extended portions of the Bush tax cuts and eliminated other portions, we see that new 20% rate for those in the highest income bracket, 15 and 5 still there. And in 2013, an element of the Affordable Care Act kicks in, a new tax on net investment income of 3.8%. So tack that on. 23.8% is the most that you can be paying now. So current treatment there, 0% for those in the 10 and 15% brackets, 15% up to the 35% bracket, 20% for those in the top bracket, and then some of those are getting the net investment income tax, bringing it to 23.8%. That is the short history, which I think is somewhat relevant, and I did want to go into that. Obviously, it's changed a lot, but some things have held constant. We have, since the advent of the individual income tax in 1913, always taxed capital gains. We have not always done so as ordinary income. In fact, that has been the exception rather than the rule, but we have taxed it. I have a question here from Kayla, asking, so which does the capital gains tax help, the businesses, the government, or the consumer? Well, it certainly helps the government. It's an additional source of revenue. I would argue in some ways it's a double tax, or at least portions of it are a double tax. The capital gains tax, of course, is making it more costly to invest in a business. If I'm an investor and I'm choosing to lend capital to a business in the form of purchasing stock, my return on investment is lower because of the capital gains tax. So the yield I need from a business is going to be higher, and the income I have to dedicate to that, the capital I have, is going to be lower. These are both constraints on business. There are constraints on me, obviously, because I'm going to receive less of a return. I'm going to pay more. I may not care for that. It's a constraint on the business because their availability of capital is limited, at least on the equity side. They may instead turn to debt financing. And of course, their stock values are lower and their capitalization is lower because there is this cost. Because markets correct for all these things, right? If the return is lower because of taxation, then the valuation is going to be lower as well. So both businesses and individual investors are certainly losing from this provision. Obviously, they'd be better off if it was lower or non-existent. As for the consumer, there's a price effect. Now, we all know, I hope we all know, that prices are not based on input costs. However, there is a point at which you cannot produce, and if all of the producers have similar constraints on them, this has an effect. Obviously, if there's no one demanding a product at a given price, it doesn't matter how much it costs to produce, basic price theory, but this tax is falling on everyone. It does filter through to our entire economy. So you see costs throughout the economy, but certainly it is reducing the capital available to businesses. And one thing we know is that capital investment is what drives economic growth. You look right now at so many companies that are sitting on a lot of assets. You may read this in the news. You look at companies that are sitting on billions of dollars and you ask, why aren't they investing? Why are they holding on to it? And the answer is there's not an investment out there worth their while that has a significant enough chance and has a high enough yield based on current policy. If the tax costs come down, more investments are suddenly viable. So this is very relevant for a lot of companies. On the government side, this is a good segue. Governments, of course, appreciate the additional revenue, but we should note that that revenue can be extremely volatile. I'm going to pull something here, so I apologize that I'm looking away. But capital gains realizations can change very dramatically. I'm going to try an experiment and hold something up to a camera. We will see if this works. I don't know if all of you can see that, but that is U.S. capital gains realizations in billions of dollars for a number of years that include the Great Recession. And you could see, I hope, some very dramatic spikes and some very dramatic changes. In fact, in the principal year of the Great Recession in New York, we have some great statistics from New York, capital gains realizations slipped by 71%. So, of course, this meant that revenue fell dramatically, and the state had been relying on that, and suddenly it was gone. Because capital gains are going to be probably some of the most volatile sources of state or federal revenue that you can find. People change their decisions on when to cash out, when to take a gain, based on economic conditions, and of course, in many years, there just aren't gains. You had years where people were taking significant losses. They were taking a bath in the market, and they may have actually taken those losses on their forms, and there was nothing there. In fact, the states and the federal government were providing tax benefits. You could take up to that $3,000 in losses. So as a source of income, it is a highly volatile revenue stream. States have looked at this on a standalone basis. Washington State, for the last few years, which does not have an individual income tax, has talked about creating just a standalone capital gains income tax. Now, there are a lot of reasons why that's probably not a great idea. But the biggest issue for them has been if they were going to use that as a source of revenue for, say, education, which was proposed, well, they could have swings of 30, 40, 50% a year, and it's really hard to fund any sort of government program on a continuing basis with swings like that. Another question from RAP, what percentage of federal revenue is supplied by capital gains taxes? Is it a significant source of income? And you'd think I would have that number right in front of me, and I don't have that number directly in front of me. It's not insignificant, RAP. I will try to come up with a number on that before the end of this webinar, but it is not a major driver of the tax code. When we've seen changes in capital gains taxes in the past, it has not been significant. In fact, there is some evidence that high capital gains tax rates actually lose money for the federal treasury. Now, you've probably heard this a lot, and I want to always caution when I say something like that, because you've all heard about the claims that tax cuts pay for themselves, and the answer is that usually they don't. That's not an argument against tax cuts, but it is an argument for some realism. You've probably heard of the Laffer Curve, and the reality is that on the vast majority of taxes, we are on the left of the Laffer Curve, where raising taxes would raise revenues. Now, it could still cost us a lot. We could see significant loss of economic growth, but not to the point where we would actually see lower tax revenue with a higher tax rate. This is one of those areas where at very least it is a close call. There is some historic evidence that when we have cut capital gains taxes, we have actually spurred enough investment that we have seen greater economic growth to the point that we're actually collecting more in revenue. I would suggest that if we're not on the other side of the Laffer curve, we're at least close enough that this is a prime candidate for reduction if we're looking at ways to grow our economy. The returns here are extremely high compared to other things you can do in the tax code. Someone asked me to spell the name of that curve. It's Laffer, named after Art Laffer, L-A-F-F-E-R. And it is a valuable device to understand, but also comes with cautions. The basic idea of the Laffer curve, for those of you who are not familiar with it, is that there is an income maximizing point or a revenue maximizing point for the government, and it's not at the highest rate. Imagine, for instance, that we take a product. Let's say, well, soda taxes are coming into vogue right now, and let's say that we set a 1 cent per ounce soda tax rate. Now, obviously, it's going to reduce soda consumption, but currently the government was raising nothing, so now they're raising a cent per ounce. Even if it reduces consumption, well, you're still going to be raising additional revenue. Now you raise it to 2 cents per ounce. If you cut consumption in half or more, you'd actually be losing. Now, you probably aren't. You're probably going to cut it by a significant amount, but not by half. So 2 cents per ounce probably still is a revenue maximizing move. Might be bad policy, revenue maximizing. What if you created it at 10 cents per ounce? What if you were saying that, when you go get that 20-ounce soda, that you're paying $2 in taxes? Well, now you probably have such a strong effect that you might be raising less money than you were at 2 cents an ounce. So you're on the other side of the Laffer curve. You have not only created potentially confiscatory taxes, but you've actually reduced the revenue that can come into the federal or state or local till. So that's the basic idea of the Laffer curve. The problem with the Laffer curve is many have internalized this to say that we can always cut taxes and raise revenue. Usually not true, because usually we're somewhere to the left of the Laffer curve. The U.S., compared to the rest of the world, is not a particularly high tax jurisdiction. Now, this is not a political statement. This is not to say that we have the appropriate level of taxation. That is something that can only be answered by individuals deciding what government should do and then deciding how it should be paid for. But we are almost certainly not on our major taxes to the right of that revenue maximization curve. But we're really close, I think, on capital gains taxes, and that's an important thing to consider, that we may have set this rate so high that we are really hampering the economy, we're hampering investment, and we're relying on this volatile revenue source that isn't really raising all that much. And I think all of these things are concerns. I want to talk a little more about what the optimal design of a tax code is, because I think that can help you put this all into context. So this is general, but again, the capital gains taxes fit into this. Taxes are ideally to raise revenue, not to guide economic activity, not to guide decisions. The more you do that, the more you're creating distortions in the economy. Of course, I think we all probably on this call believe in a market economy. And a market economy should be guided by those principles, not by the government. There's no way the government can avoid that entirely when they are imposing taxes, but we want neutral taxes. We don't want the government picking winners and losers. We don't want distortionate taxes. We don't want taxes falling multiple times. So think of a classic example, sales tax versus what's called a gross receipts tax. A sales tax ideally applies one time. At the final transaction, you buy a good or service for your use and you pay a sales tax. A gross receipts tax applies at every stage of the production process, over and over again, and it's embedded multiple times in that product. So you might have one product that has a really short production process, and it's fine. It's taxed one time, maybe twice. You have other products that might be taxed 5 or 6 or 7 times. That's highly non-neutral. We want to avoid that sort of double taxation. Another thing we do to avoid double taxation, you look at state income taxes. Imagine you're a company that works in multiple states. Let's say that you work in Virginia, Pennsylvania, and Illinois. Now, you do some work in Illinois, and you pay Illinois taxes, but you're based in Virginia. And you do some work in Pennsylvania, and you pay Pennsylvania taxes, but you're based in Virginia. Well, now what? Do you pay Virginia taxes on that too? The answer is actually yes. Initially, you'd pay Virginia taxes too, but then you'd take a credit for the taxes paid to other jurisdictions to reduce your Virginia liability because we want to avoid double taxation. We want to avoid it both because we think this is generally wrong, but also because it's distortionate. Some activity is penalized compared to others. And that's what we're doing with capital gains taxes, because this decision of individuals and businesses, because businesses are involved in this investment as well, through other companies, to invest in some sort of, to take some investment opportunity, try to get a return. Their potential return is being reduced. It might even be made negative. This is affecting investment decisions. Businesses and their income are being taxed at multiple layers, again, at the entity level, at the ownership level, at the capital gains and dividends distribution level, and this is changing economic activity. This should be a concern for us. These optimal taxes aren't imposed at intermediate levels. They're taxed one time on one set of assets or one set of income. Income taxes, as we mentioned, are changes in investment value. They're only taxed when realized. So when you look at a capital gain, you're obviously only being taxed when you sell the asset. That's a good thing, because otherwise you'd be paying on potentially phantom gains. The downside, though, is that we are treating gains and losses differently. That is creating some non-neutrality. Again, it is hurting the decision-making of individuals when they participate in the market. Consumption taxes, as mentioned, they affect different things. So a corporate tax or any tax on business is affecting labor. It is affecting investment. It is taxing consumption. A consumption tax is only hitting one of those. If you double tax this, you are potentially creating a situation where all of the possible sectors of the economy are being taxed multiple times. This is probably one of the most anti-growth things you can be doing. I've got a question here, but shouldn't the fat cats who get the big capital gains get to pay more taxes to help support those in society who for one reason or other are poor, disabled, disadvantaged, etc.? And this is a very legitimate question, and it goes to the broader question of progressive systems of not only taxation but of transfers, because we have both of those. We have a social safety net, we have a welfare system, and we have progressive systems on both sides. And listen, there are great arguments for these things. The question in my mind, the question I want you to ask yourself is, how do we maximize as many of the values we want? Because we can raise the same amount of revenue in a lot of different ways. It matters how we do so. It matters whether we are promoting economic growth while we do so or whether we are hindering it. We are clearly going to, in this country, have progressive taxes, and we are going to have a progressive distribution through entitlement spending and social programs and various welfare programs. And we can have all of those things. And if you want to tax high-income individuals more, there are ways to do that without hindering investment as much. Capital gains taxes are going to be worse than individual income taxes. And consumption taxes are going to be better than both of these. And you think, okay, well, but how is that going to hit the higher income individuals? Well, two things. One, at the federal level, we could have a VAT. And a VAT would be capturing a lot of economic activity that's not being captured under sales taxes right now, and could shift much more towards some of those high-income purchases. And at the state level, you see the same thing. Think about what's in your sales tax base. Most of the goods you buy are in the sales tax. Very few of the services you buy are in the sales tax. And think about who is consuming services versus who is consuming goods. Now, part of the reality is we're all consuming services. We are a two-thirds service-oriented economy these days, and that's a complete flip from 50 years ago when it was two-thirds goods-oriented. But higher income individuals are buying and utilizing a lot more services, whether it is things like landscaping all the way to legal services, accounting services, all manner of professional services. These are high income, and we're generally keeping those out of the tax code. So if someone has a concern that the tax code is not progressive enough, or that the entire system is not properly distributing income, but these are separate questions than capital gains taxes. What I would ask you to bear in mind is that there are better and worse ways to raise a dollar of revenue. And we may have all of these goals in terms of how we benefit or try to assist low-income individuals. We should also think of how we raise that revenue and whether it is in a way that gets out of the way of the market enough to allow a significant pro-growth policy, or whether it is double and triple taxing certain types of income. Another question is there a lot of corruption with how capital gains and losses are reported? And that's a really good question to which I don't know if I can give a definitive answer, but I would say probably very little, in part because there's reporting on almost all of this. You know, we have a Securities and Exchange Commission, and there are requirements that any sort of listed corporation that issues stock has to provide the SEC and the IRS with information about stock sales and dividends and interest and all of the information that goes into your form. You know, if you use any sort of brokerage service, if you have any personal investments and you use a brokerage service, you probably receive a form at the end of the year that tells you pretty much what you owe and everything you need to put on your form. Well, you're not the only one that got that. The IRS did too. So if you diverge sharply from that, the IRS may well take notice. There could be an audit. Now, they don't have the resources to audit everyone, but this is actually an area, just like with wage income, where they have the documentation. They have your W-2s for wage income. They have your forms on your, your investment income. There might be some that's not included on that, but for the most part, they would be able to catch a large divergence. So one wouldn't expect that there would be a significant amount of underreporting or corruption or illicit tax avoidance in this particular realm. What you would expect is a lot of tax planning, because capital gains, especially the big capital gains that governments really want to get their hands on, often are in the hands of high-income individuals who have good financial planners, who have often very good financial sense, and they will be trying to maximize their own gains and minimize their own tax liability. We're talking about legal tax avoidance and reduction of tax incidence, but higher income individuals have more ability to make economic decisions that limit their tax liability than do low and middle class individuals. So when you have a tax like this, you're going to see more legal tax avoidance or at least delays on taxation. You might note, of course, that ideally a tax code doesn't provide these opportunities. The more neutral a tax code is, the fewer winners and losers it picks, the more that it just has one system that works for everyone, the harder a lot of these tax games are. Do we have any other questions? I can talk about other things, but want to see if there are any other questions before we go on just the where capital gains stand. All right, we'll leave the questions open for now. And anyone else, please feel free to jump in. But broadly speaking, as you try to determine should capital gains be taxed, remember, of course, that they always happen. Remember that this would be a very significant change in tax policy and one that probably has significant political ramifications because, as was noted in some of the last questions, this is a tax that's perceived as being on high-income individuals. Note the proviso and the caveat, though, that the vast majority of us have some sort of investments, even if we're not trading stocks. Maybe we don't have a personal brokerage account. Maybe we don't have our own financial planner. We have 401ks. We're in pension plans. Capital gains affect all of us, and obviously there are some tax advantage plans. So the 401k up to a certain amount, you have these tax advantages, but these exist because capital gains hit all of us. And you might think, well, okay, I only have 401k income. I'm not affected because I'm only paying on one side. Maybe I've got a Roth IRA. Maybe I've got 401k tax advantage. Well, okay, but the company is earning less because of the higher cost of investment. And that's why this affects all of us. We have to think of the economy as this interconnected whole. It's not just the investor. It's also the business and its ability to have investment opportunities that are profitable, the yield there, and again, this flows through to prices as well. This is one of the taxes that we probably see some of the more adverse effects. There are more fundamental philosophical questions on what sort of income we should be taxing. Of course, wage income is the most prominent category. And we could ask lots of questions about why we choose to tax income. I think the realistic answer is because it's readily available, it's easily reportable, and governments need revenue, and they probably don't have much more philosophical justification than that. But governments have sometimes justified income taxes on the fact that they enable certain economic activity, that they provide the markets in different ways, and one can agree or disagree with that. But obviously governments do regulate business. So you have an income tax on your wage income. Governments regulate markets in different ways as well. Should you have a tax on capital gains? Is that different than wage income? A question you need to wrestle with. At very least, I think it's different for two reasons. One, the level of double taxation. Two, the inflation issue. Some might argue that it is different in a more fundamental way, that one has already earned this income through one's wages, and if one finds a way to have it appreciate and do so by investing back in the economy, that maybe that shouldn't be a taxable event. Of course, on the business side, generally speaking, it wouldn't be. On the individual side, it is. So again, that dichotomy is there, something certainly to think about. But broadly speaking, as you're thinking about these questions, as you're trying to handle how you will debate this issue, I would encourage you to look at the economic literature. Look at the effects on investment that are associated with business taxes versus individual taxes versus consumption taxes. Look at the level of double taxation. Try to assess just how many times a particular dollar of investment might be taxed by the time it actually reaches someone. And try to decide what your theory of taxation is and what is legitimate to be taxed, what shouldn't be taxed. Now, I'm not offering you a theory on this. I'm not sure that there is a whole lot of a difference between income in the ordinary sense and capital gains income from a philosophical sense. But there are those who believe there is. But there's certainly a difference on, again, the double taxation argument, the interest, or the inflation argument. I see someone else typing. I've really probably covered most of what I have, but I do want to answer further questions. So if anyone has further questions, please go ahead and type those in now, and we'll try to get to anything we have before the end of this call. I'm hearing a lot of reasons why capital gains taxes are a bad idea. Double taxation impacts different economic, socioeconomic classes differently, inflation arguments. Could you sum up the biggest reasons to defend a capital gains tax? And that's an excellent question because, yes, perhaps I've been more on the negative side, which isn't to say I think that we should repeal them, but I certainly think that we should be very concerned about those rates. The arguments in favor would probably mainly be distributional arguments. They would be questions of income inequality. So you would just, again, have this question. This is a type of income and a type of activity that is disproportionately engaged in by higher income individuals. Now, many of us, most of us invest, but when we think about the overall share of investment, it's going to be fairly high income. The other arguments for a capital gains tax, some of them simply come down to this is income, and why wouldn't it be taxed? You can do a lot of things with your income, but if you are able to obtain additional income, whether it is by your labor or by your investment choices, there's a question, why shouldn't it be taxed? And I think that's actually a perfectly valid argument, but again, the fact that it is already being taxed at multiple levels, at the corporate level, already for you at the individual level before you invested, makes that perhaps less of a compelling argument. It's not so much should it be taxed, but how many times it should be taxed. Do we have further questions on this call? Because I think we're going to wrap up a little early. I don't think there's anything wrong with that, but want to make sure that we have an opportunity for everyone to get their questions in. All right, well, Maddie, if it's all right with you, we may leave it there. I appreciate all the questions we got and hope that helps at least inform some of the further research all of you will be doing. So thanks for having me.
Oh, it looks like there might be one more question.
You do.
All right, I'll go back off.
And we'll just give that one moment. I know that we're in this, I get to speak. You all have to type. A little bit of inequity in there, but we'll provide a moment for someone to ask one more question. I would also say that, I work for the Tax Foundation. I'm not speaking for the Tax Foundation today, but we do have a lot of resources on our website about capital gains taxation, some good papers you may wish to read. So that's taxfoundation.org, just a plug for our group, but you may find some resources that are helpful to you, and also some data tables that may be useful as you review this and form your arguments. All right, one final question. Are there specific historic times in American history when capital gains taxes have been exceptionally influential in impacting the economy that I know of? That is a really good question, and one I might have to think about a little longer. But I would suggest that that period between 1913 and 1921, there was a good reason for why we saw that shift. Because originally, individual income taxes fell on very few people. Top rate of 7%, but the real issue was that only a few percent of Americans were paying income taxes. And very few people had reportable capital gains. This was not an era where many people were actually investing in the stock market. We started to see more people investing in the subsequent years. Of course, we actually had a stock boom for a while, and wars can help this in the short term. You've probably heard all the long-term arguments, broken windows, ideas of why this isn't really a long-term economic benefit, but GDP can increase during war, so we saw some of that during World War I. But taxes are rising really fast. And again, you get a 73% top marginal income tax rate by 1921. Now, 73% on capital gains is just untenable because you already now have corporate taxation. This has come into existence as well by this point. Excuse me. You have corporate taxation. You have individual income taxes, capital gains taxes. You're getting really close to taxing 100%. There's almost no reason to be engaging in economic activity in this way, no reason to invest. And I have to think that that drove a lot of the decision to radically ratchet that rate down. So when in 1921 the Congress cut the top rate to 58%, they didn't keep capital gains taxes there. They brought them all the way down to 12.5%. I have to think they recognized that differential. And clearly in a few years, they also recognized the inflation argument by using those different, those different deductions to try to address that. So pretty early in the history of capital gains taxes, the limitations were realized. Addressing them has always been difficult, but these limitations have been recognized at least since the late 1910s. And if that's it, Maddie, thank you for having me.
Yeah, thank you so much for taking the time out of your day to talk to us about the capital gains tax. I know this was very helpful. Now, everyone, I am going to send over my email. Please feel free to email me if you have any further questions or if you would like links to more resources. I'm more than happy to provide that for you guys. Also, this recording is going to be posted on YouTube sometime within the next 48 hours, hopefully sometime tomorrow. But that's just about everything that I have, guys. Now, I'm going to go ahead and shut down this meeting room. It's going to direct you to our We the Students essay contest. Please take a look at that if you have not yet. You have the chance to come to DC and get a scholarship to Constitutional Academy, as well as your chance at $5,000. So it's worth a try. So I'm going to go ahead and direct you guys there. And I hope you guys have a wonderful night. And like I said, feel free to email me if you have any questions. Thank you, Jared.
Thank you.